You're a single member S corporation owner paying more money than you ever dreamed of in taxes. So am I. I'm Brad, certified financial planner and your retirement readiness coach, here to bring you 5 strategies to help lower your tax bill both now and in retirement and build wealth for the future. Today we're going to talk about 5 ways to help lower your tax bill and build wealth for the future. Like you, I'm an S corporation owner as well, and I've taken advantage of all 5 of the things I'm about to share with you. Now, unlike you, I have employees, and so you're at a distinct advantage because you don't have employees, and I'll explain that in a minute. So the first tip that I want to give you is I want you to use a solo 401k for your retirement savings vehicle. So I want you to open a solo 401k. Here's why. I know many of you like to use a simple IRA or a SEP IRA, and those vehicles are fine, but here's why I like the solo 401k over the simple and the SEP. The first is you can get more money into a solo 401k than you can a simple IRA. You can get $23,000 in on your employee deferral portion if you're under the age of 50, or you can get $30,500 in if you're over 50. This is more than what you can do on the simple. In addition to this, you can also take advantage of doing the profit sharing contribution on top of your employee deferral. And this allows you to get $69,000 in if you're under the age of 50, or $76,500 in if you're over the age of 50. So the employee deferral allows you to put 100% of your income into the solo 401k, and then the profit sharing component is a percentage-based calculation, just like the SEP IRA is. But all told, you can get more money into a solo 401k in a more efficient way. And for those reasons, I really like it. In addition, you can also take loans against your solo 401k. Not that we want you taking loans against your retirement accounts, but as a business owner, it's nice to know that you have access to additional capital should you need it. Now, the second tip for the day, I want you to consider adding your spouse to payroll. Now, your spouse does need to have a legitimate role in the company. You need to have a job description. He or she does need to be a working, but hey, if you're a business owner and you're married, you know that your spouse you're in this thing together. I know how it is. That's how it is with my wife. And so if you add your spouse to payroll, now you can do this times 2. You can rinse, wash, and repeat. And now your spouse can also contribute to the solo 401k and the profit sharing component if you want to. If you just want to keep it simple and keep the wages lower, then just have your spouse contribute the employee deferral portion. But either way, it's a nice way to contribute more money, which is giving you a much bigger tax deduction. It's keeping the tax bill lower. The third strategy I want to share with you is if you're looking to contribute more money than what we're looking at here on the solo 401k, you can establish a cash balance pension plan. The great thing about a cash balance pension plan is you can contribute so much extra money to the cash balance plan than you can to a solo 401k. I've seen some plans where people are able to contribute an additional $200,000 to the cash balance plan. Now, there's some things to know about it. This does come with some additional administration, which is going to require some extra costs. Think $3,000 to $5,000 extra cost per year. But if you're able to get $200,000 extra into a retirement account, it's lowering your adjusted gross income by that amount. And if you're in high income brackets, this is a huge tax savings. The other thing, cash balance plans are a little bit different than solo Ks in that they require you to make a commitment for at least a few years of making contributions to the cash balance plan. So if you're in a situation where you're in a high income tax bracket, you have good cash flows, and you think you can commit to making these contributions, a cash balance plan is great. And hey, you don't have to commit to contributing $200,000. You can choose a much smaller amount, but this has been a tool that has been used successfully by a lot of business owners we work with. Again, fantastic way to lower the tax bill and start to build wealth for the future. And now the fourth thing I want to talk about is I want you to consider adding your kids to payroll. If you have kids, and they do need to be old enough, and every state is a little bit different. Some states say age 8, age 10, age 14. Again, it's state by state, but I want you to consider adding the kids to payroll. And here's what you do. You're gonna add the kids, and you're gonna pay them about $12,000. Now, how I came up with that amount is that's the federal standard deduction amount. In other words, if you pay the kids $12,000, they won't owe anything in federal taxes because the standard deduction will eliminate the need for them to pay taxes. Depending on the state that you live in, they might owe a nominal amount for state taxes, but it's pretty nice to be able to pay them $12,000. Now, this does have to be legitimate. You need a job description. They need to be doing real work for your business. Run this by your CPA, of course. But assuming that you dot your I's and cross your T's, this is a great strategy. And now here's what the kids should do. The kids can take the $12,000 that they've now just gotten tax-free, and they can make contributions to their 529 plans. And in this way, it's a roundabout way of you getting money into your kids' 529 plans tax-free. It's a really nice strategy. The other concept, maybe the kids aren't going to go to college. Maybe the 529 plans are fully funded. Understandable. So the other thing the kids could do is they could make contributions to their own Roth IRAs. And by doing that, you're helping your kids get an early start to build wealth. And we all know the value of compound interest. So helping them make tax-free contributions to the Roth IRA, that's a pretty good strategy. So either way, either help you help them or help your kids in the future. These are great things to consider by adding your kids to payroll. And the fifth and final tip that I'm going to give you today is, now that you've done this and put these plans in place, you can now take advantage of doing the backdoor Roth IRA strategy. Let me explain. So currently, most likely you're not able to get money you're not able to contribute money to a Roth IRA because you make too much money. You're a high income earner. So by opening up the solo 401k, this is another reason why I like solo 401ks. What you do is you take all of your traditional IRAs, maybe you have a simple, maybe you have a SEP, maybe you have a traditional IRA, and I want you to roll them up into the solo K. There's no tax consequence to do this. There should be no cost to do this. You roll them up into the solo K, then you can manage it, and I want you to use low cost ETFs. That's what we prefer to use. Low in cost, they trade for free. You can build out really good globally diversified portfolios doing this. But by getting your money out of IRAs, here's why you can do the backdoor Roth. You now make a contribution to a traditional IRA, and because you're a high income earner, it's not deductible, but that's okay. You're not doing it for the deduction. You make the contribution to the traditional IRA, and what you do is you convert it over to the Roth IRA. And because you already paid taxes on the non-deductible contribution, you do the conversion. The conversion is tax-free. And what makes the conversion tax-free is the fact that you've taken those old IRAs that you have, you've rolled them up into the simple IRA, and you're avoiding what's called the aggregation rules. Now, I'm not going to explain all the details on this. I've got another couple videos and a blog I've written on this. So go track them down, or call me if you have detailed questions. But the strategy is roll the old IRAs up to the solo K, and then make the contribution to the non-deductible IRA, and then immediately convert it to the Roth. That's the backdoor Roth IRA strategy, and you can do it in a completely tax-free and legal manner, okay? I know I threw a lot at you right there. This can be a challenging subject, but do you have any tips that you'd like to share with the audience? If so, leave them below. We'd love to know what you're doing to help lower taxes and build money for retirement. And if you found this content helpful, please share it with any other business owners you know who can benefit from it. We look forward to seeing you soon.